This is your Wall Street wake-up call. Global markets await the Federal Reserve's all-important March statement. I'm joined now by Jasper Lawler, a market analyst at CMC in London. So Jasper, set the stage for us. I mean, if this meeting was happening a month ago, I mean, the Fed would be facing a much worse situation. The markets seem to have calmed down over the past couple of weeks, with the exception, of course, of some weak retail sales data.
Hi, Scott. Absolutely. I think that's the key thing that we'll be looking out for here. I think the market consensus is that rates will probably stay on hold at 0.25 to the 0.5% range, and that likelihood is that the Fed will slightly guide lower on their dot plot, suggesting a slightly slower pace of rate hikes this year. I would go along with that. I think that's probably a foregone conclusion. But what's key is how they assess their balance of risks. And as you said, risks are looking a lot more benign now than they were just even a month ago. Looking at barometers like the US dollar, it's lower. Looking at equities, they're higher. Oil is higher. Credit spreads are looking a lot more favorable. So that financial tightening that really worried the Fed and put them off raising rates at the start of this year doesn't really seem to be as actively in place now. And I think probably looking back, the Fed would actually probably have liked to have been able to hike rates this time around, but they've already kind of boxed themselves into a corner, and so maybe what we're looking for is for them to signal an imminent tightening, perhaps even as early as April.
Well, and I want to ask you about that April statement, but first let's talk about the consumer. When we see this huge downward revision in January's retail sales data, I mean, what does that tell you? I mean, how worried should investors be about the state of the consumer?
Well, it just tells you it's a fragile recovery still, and that's pointing to sort of 2% GDP growth because you don't have the support of what is the backbone of the US economy, which is consumption. It is a worry because obviously you would expect consumption to pick up with that benefit from the lower fuel prices, but that hasn't happened. There are some other factors affecting how much Americans have in their pocket. I think one of them is healthcare costs, and one of them is rent costs. Those two things are feeding into higher inflation, but they're also taking away from how much wealth people have in their pocket, and it's affecting spending. It doesn't mean the economy is about to get derailed and be sent into a recession, but it really weighs on the growth.
All right, now if the Fed were going to hike interest rates in April, what would they have to say in their March statement to sort of prep the markets for that? Are there any clues we should be watching out for?
I think it is going to come down to this balance of risks, and just saying that the balance of risks have subsided, something along those lines. They would have to be fairly explicit because obviously April doesn't have the accompanying press conference in which they could explain the decision. So in essence, they're going to have to half explain the decision now and then half explain the decision in any upcoming speeches. So it would be a difficult one to play. So I think they're going to have to be fairly explicit, but they probably don't want to entirely box themselves in. So they're not going to say it's, we're looking to reassess our policy, something along the lines of what Mario Draghi said at the ECB. It couldn't be quite that explicit, but something about how the risks have reduced, I think, is how they'd probably do it.
All right, and just very quickly, I mean, how do you think the markets will react to a no rate hike decision today? Will it sort of help us maintain the rally we've seen?
I think maybe it's the fact that they're probably going to lower guidance on the number of rate hikes this year, which is going to be supportive of markets. And as long as they're fairly, positive about the US economy, then in essence, markets are getting best of both worlds. The lower pace of rate hikes, but also the stronger looking economy, which can still justify some more rate hikes this year. So I think that best of both worlds scenario would be supportive of stocks and can help us carry on through and hold above 2,000, the S&P 500, and push further above 17,000 in the Dow Jones.
All right, Jasper Lawler, a market analyst with CMC Markets in London. Jasper, thanks so much.
Thank you, Scott.
I'm Scott Gamm, and you're watching The Street.